An accumulation of recent data suggests that the global economic landscape started to shift in the second half of 2016. Developments since last summer indicate somewhat greater growth momentum coming into the new year in a number of important economies. Our earlier projection from October that world growth will pick up from last year's lackluster pace in 2017 and 2018 therefore looks increasingly likely to be realized. At the same time, we see a wider dispersion of risks to this short-term forecast, with those risks still tilted to the downside. Uncertainty has risen. Our central projection is that global growth will rise to a rate of 3.4% in 2017 and 3.6% in 2018, from a 2016 rate of 3.1%. Much of the better growth performance we expect this year and next stems from improvements in some large, emerging market and low-income economies that in 2016 were exceptionally stressed. That being said, compared to our view in October, we now think that more of the lift will come from better prospects in the US, China, Europe, and Japan. A significant repricing of assets followed the U.S. presidential election. Its most notable elements were a sharp increase in U.S. longer-term interest rates, equity market appreciation, and higher long-term inflation expectations in advanced economies, along with sharp movements in opposite directions of the dollar up and the yen down. At the same time, emerging market equity prices broadly retreated as currencies weakened. In light of the U.S. economy's momentum coming into 2017 and the likely shift in policy mix, we have moderately raised our two-year projections for U.S. growth. At this early stage, however, the specifics of future fiscal legislation remain unclear, as do the degree of net increase in government spending and the resulting impacts on aggregate demand, potential output, the federal deficit, and the dollar. At the global level, other vulnerabilities include higher popular antipathy toward trade, immigration, and multilateral engagement in the U.S. and Europe, widespread high levels of public and private debt, ongoing climate change, which especially affects low-income countries, and in a number of advanced economies, continuing slow growth and deflationary pressures. In Europe, Britain's terms of exit from the European Union remain unsettled, and the upcoming national electoral calendar is crowded, with possibilities of adverse economic repercussions both in the short run and the longer term.